Okay, we're going to go ahead and get started here. Thanks everybody for jumping on. Really appreciate you doing so. It's a beautiful day in Charlotte, North Carolina today. It's sunny at noon. Um, I don't know about everybody else. My kids are back in school, so that certainly is a big milestone for us. And the end of summer is always a bit of a challenge around my house, so it's nice to have kids back in school and sort of getting into a new schedule. Hope everything is good where you are. But really appreciate you jumping on. Today we're going to be talking about retirement planning. We're going to go through a case study of retirement planning for Atrium physicians. This process is extremely important to our clients, and we're going to take you through a sample client and see exactly what the retirement planning process looks like. But before we do that, for those of you that don't know me, my name is Benjamin Dolan, and I'm the owner of Dolan Capital Advisors. We're a financial planning and investment management firm based here in Charlotte. We currently manage about 140 million in assets. We have a fiduciary relationship with our clients, which means we are working in their best interest at all times. And we're a fee-only firm, which means our only source of compensation is from our clients. We think that's crucially important. Today with us is Michael Foster. Michael is a wealth manager here at Dolan Capital Advisors. He's a CFA and a CFP. He grew up in Fitzgerald, Georgia, got his BA in business administration at Georgia Tech. And in 2017, he joined Dimensional Fund Advisors, a big asset manager with the East Coast headquarters here in Charlotte. He just recently purchased his first home in Charlotte, I believe.
That's true.
He married up to his wife Grace. I know what that's like. I married up as well, and he's been bragging recently about his single-digit handicap. And so that's good for Michael with all the work he's put in on the golf course as well. But we're glad Michael's here to join us and to take us through some of the retirement income planning that we do for our clients. First, we're going to take a look at the details for our case study today. So we're gonna do a hypothetical client. So physician and spouse, both 45 years of age. Income, physician making $450,000 a year, spouse making $80,000 a year. Current net worth approximately $1.5 million, and with specific goals that they want to reach throughout their retirement. So they would like to retire at 62 or younger if possible. They don't want to outlive their money, and they don't want to be dependent on their children. This is one that we hear a lot, obviously. We're yet to meet a client or prospect that says, boy, I would really like to outlive my money. And so it's very important that as we live longer, as we're healthier for longer, hopefully, that our money can take care of us, and we don't want to depend on our children. Finish paying off student loans, certainly a big one for physicians. They want to provide 100% funding for in-state college tuition for their two children, currently ages 9 and 12. And they don't want to have a reduction in lifestyle as they transition from their working careers to retirement. And then finally, they are interested in possibly a beach house. So that's lower on the priority scale, but they may want a beach house. So this is sort of a typical situation that we might see with some of our physician clients. And Michael's going to take us through the process of retirement income planning. So Michael, I'll stop sharing and let you share, and you can take us through it.
Yeah, perfect. Ben, I'll get that pulled up. And while I'm doing so, I wanted to say I was trending towards a single-digit handicap. Not there yet. We'll be there.
He's being modest, folks.
Yeah,
He's being modest.
We're working hard. So yeah, like Ben said, I'm Michael Foster, and I'm a wealth manager here at DCA. And we really wanted to take you through, using that background on the case study, one of the many tools that we get to use with our clients. My favorite thing about this tool is that it's not prescriptive, but rather is highly customizable to each client's unique situation. So for the sake of today, obviously, we're going to be walking through this hypothetical case study example, But know that we go through this with clients that are in their 30s, in their 80s, those with goals all across the spectrum. So while we're walking through this today, we're going to show you how it looks for this particular case study, but know that we can get as granular as our clients want to when going through this. So starting off here, the first thing that we focus on within the system is the net worth statement. Ben already mentioned to you that the client's net worth is about $1.5 million, and that's derived from their assets minus their liabilities. For the sake of the analysis that we use, we only use financial assets and real estate typically as assets. We know that people also typically have vehicles that they drive, maybe some jewelry, some artwork, furniture, things like that. Unless those are highly collectible and have a value that tends to go up over time, we don't typically include them because we don't like to include depreciating assets as part of the analysis. So just taking a look at this sample case scenario and the client's assets and liabilities. First and foremost, they've got their bank balance here. They've got their standard banking balance to meet those, call it monthly to a month and a half of expenses. And then as well as their emergency fund for those home projects that come up, the HVAC goes out, tire blows on the car, things like that. And they're getting that in a high yield savings account to generate some yield. They also have their investments. So you'll notice here some accounts that might look typical to you in the Atrium system. Atrium in particular has a variety of different retirement plans, mostly along the pre-tax spectrum. But you'll see here we have some hypothetical balances listed for that CHS&G plan, the Advantage plan, the standard 401k, some taxable savings on the side in a brokerage account, the spouse's 401k, and then some smaller balances in things like a health savings account and saving for those kids' college tuition and 529 plans. Their other main asset currently is their primary home. This is often people's biggest asset, especially in their earlier years of their career. You can see here we've entered some hypothetical numbers for the value of the home, purchase price, taxes, maintenance, insurance, things like that. I want to point your attention towards the tax, insurance, maintenance, as well as the mortgage and student loan payments that we'll show in a minute, as those dollar amounts are not going to be included as part of a target monthly spend. We like to strip those out and focus them on the asset. And when we're looking at the monthly spend, we want that to be things that are related. Maybe it's discretionary spend, utilities or other fixed items, but things that are not necessarily tied to one of the assets in the net worth statement.
Okay, so those expenses are included in the analysis, even though they're not part of a larger expense item.
Yes, absolutely, Ben. So it's helpful when having them in here because there are sections within the tool that you can go look. Let's say the actual expenses for your home, not just the mortgage value. You can factor in things like taxes, insurance, maintenance. You can factor in different inflation rates for these things as well as the part of the system. That's maybe getting in a little bit of the weeds for this conversation. But in terms of that target monthly spend, yes, it'll be the dollar amount that we show later, plus, in this case, the $8,000, $8,500, and $5,000, and then the mortgage and loan payments.
Great.
Yeah, so to take us to those mortgage and loans, you'll notice here the negative sign, the parentheses around here, symbolizing debt. We've got this client with about $350,000 of mortgage left on the home with a $3,000 monthly payment, as well as some student loans still in the system. So, obviously not uncommon for those in the medical profession to have some student loans, well into later in their careers. And for the sake of this example, this client also has some student loans to the tune of about $50,000 left to pay off.
Sure.
So factoring in all of those assets and those liabilities, that's how we get to this net worth number. In this case, it's a nice clean 1,555. But obviously in real life, you get down to the nitty gritty balances and maybe have less round numbers. But for the sake of this, they've got the nice 1.555 million net worth.
And
The next thing, yeah, sorry, go ahead.
Sorry. And for our clients, just so everybody knows, we're trying to keep this pretty simple today. The system does allow for us to put in insurance, other assets like Michael talked about, but for today, we're just sticking strictly with investments and real estate.
Yeah, that's a great point, Ben. Again, when I mentioned at the beginning, as customizable as you would like it, we have some clients that like to see things at rough round numbers, high level, and we have others that like to get down to the nitty gritty and track their credit card purchases in here down to the cent. And you can do everything in between as part of this tool. But yeah, like Ben said, for the sake of what we need to do today, I think the high level round numbers will show some of the capabilities.
And clients can link accounts in here as well, correct?
Yeah, absolutely. They can link accounts, get access to this, and be able to play around with some of the tools that we're going to look at today on their end, in their own spare time. We have a few that like to do that. I say most of them like us to update it and share the results with them versus them playing around with it. But
That's fair. That's
yeah,
fair.
it is across the spectrum though.
Sure.
So yeah, before we get into the analysis, this, like any other tool, the outputs that you're going to look at are only as good as the inputs that you put in. We've talked about some of the inputs here on net worth, but we also need to go through some of these sections. So starting off with family, I'll hit this very quickly because Ben highlighted this on the case study background, but we've got the physician spouse, both age 45, and then 2 children, ages 12 and 9. We've got their current expenses. So, tax filing status, they're married, going to file jointly, and then these pre-retirement living expenses. This, again, to go back to what we were talking about in the net worth statement, is excluding those expenses for the home as well as paying the loan payments. So this is $12,000 excluding mortgage payment, excluding home insurance, maintenance, taxes, things like that, as well as a student loan payment. So this would encompass, call it everything else. And that would lead to a total spend of closer to the $16,000 a month, or even a little bit higher once you factor those things in.
Yep. Great.
After expenses, we'll go to current income. Ben also hit on most of this. We've got the physician's salary as well as the spouse's salary. The system will actually calculate based off of these salaries, Social Security based on historical earnings, as well as projected future earnings, as well as there is a legacy Atrium pension for many doctors, and we wanted to include a modest amount of income starting in retirement for that pension. Current savings, we've got the different accounts listed here, the physician's 401k, the spouse's 401k, that joint taxable savings, some 529 savings. Please note, those are annual dollars in these, not monthly dollars. As well as the CHSMG can't contribute to, Advantage plan putting something in there and then maxing out the HSA. Again, just a hypothetical scenario. Most clients don't have this many options as it pertains to their retirement plans, as well as I'll shout out Atrium here in that their match and contributions that they make to the plans and we see is higher than most typical employers as well. So we can actually get down, talking about getting down to the nitty-gritty in the system in terms of their actual match of that 6% and then the flat percent match as well.
Certainly a great match for those that are involved in the plans. I also really like this because you can see that you're filling a lot of different buckets with this plan from a savings standpoint. So we always like to talk to our clients about how they're saving in various buckets, pre-tax, after tax with the joint taxable, and then typically tax advantage with the Roth or the health savings account. So I think this is a really good look at the savings component and how all those different buckets work together. So very helpful.
Yeah, absolutely. That's a great point, Ben. So now that we're done with kind of those tiles, we'll go to the one that's often most fun to discuss. The goals tile should probably be highlighted in yellow or something like that, so it stands out a little bit more, in my opinion. But this is where we can really start having some fun in the system of saying, all right, what do you want your retirement to look like? For the sake of this case, we have the physician and their spouse wanting to retire at age 62. So early, but not so early. Oftentimes we see that physicians can experience higher rates of burnout, maybe than just the average profession. So we tend to see them at least wanting to retire earlier if possible. We talked about not wanting to have that cut in lifestyle in retirement. So we still have the $12,000 monthly expense here. And I'll add, this might even, when you think about it, be an increase in lifestyle, because assuming that the kids are off your payroll at some point, you wouldn't have those mouths to feed, expenses associated with that, and all of that can go back in your pocket. I should add too as well, I should have said this at the beginning, everything that we're looking at is in today's dollars, and the system will inflate everything out using a standard rate of inflation for 3%, and then 5% for things like education and healthcare, as the inflation on those tends to be a little bit higher than the national average. So when we say $12,000 in retirement expense, that's $12,000 in today's dollars, not saying the current 45-year-old 17 years from now wants to spend just $12,000 a month. That number would be inflated.
That's a great point. Yep.
Yeah. So a few other things that are in the system now, again, also in today's dollars, involve healthcare and long-term care. So as you likely know as physicians, the average person's healthcare costs go up in retirement. And what this number that's just shy of 6,100 for each, the physician and the spouse, represents is the additional average cost that someone spends on healthcare in retirement. We also have long-term care cost here. This number, again, is a national average, but what this is it's going to be a national average of 1 year of in-home care. So, $68,000 and change per person for 1 year of in-home care. For the sake of our system and standard assumptions, we typically plan out to age 95 unless told otherwise by a client. And we assume the last 2 years, so ages 94 and 95 for both, have that in-home care. This is where obviously we have to make some assumptions. We think it's prudent to put something in the system around long-term care, but the actual reality of what the future holds is certainly less known. We can make edits to this as well when thinking about things like family history, current health status. If a client has an existing long-term care policy, again, being able to customize it down to as hyper-specific of the situation as needed.
I think that's a great point, and we are always having conversations with our clients, like Michael said, about health history, or if they're just wanting to be really conservative when it comes to long-term care costs. If they want to look at 3 to 4 years, 5 years even of nursing home care, then we will put that into the system, and that can be the assumption going forward. So when it comes to healthcare costs and retirement for those two titles Michael just pointed out, it is a discussion, and then it's sort of adjusting going forward to what they see the best fit is going to be.
Yep, absolutely. Some more national averages, and similarly, you can get as customized as you want, is around college and these education savings goals. That number there, the number just shy of 29,000, represents the national average for a public, in-state, on-campus, all-in education, again, in today's dollars. So the tool is actually really cool to where this is kind of our usual starting point for most people, but you can get in here for the sake of this case, the client wants to pay for all of the education, but we can actually add in things like expected scholarships, or if they want their kid to, quote unquote, have some skin in the game, maybe have to get a job or take on a tiny bit of debt of their own, we can add in things like that, as well as we can get as granular as entering specific colleges and factoring in their tuition cost. Say if you think your child is likely to go to a private out-of-state school, or me being a Georgia Tech alum, if my kids want to go to Georgia Tech, I can enter in what out-of-state costs would cost for that. So you can get very, very granular.
That's great.
Yeah, it's a great part of the tool as well. And then finally here we have the beach house. Ben mentioned a modest beach home. We have that priced $500,000 in today's dollars, being purchased at retirement, so age 62, being able to access that day one in retirement, and then holding on to it for 20 years. We don't see typically that most people that have beach homes tend to be going to them when they're 93. But again, in the system, we can have it go out as long as possible.
Now, Michael, how does it project the real estate going forward? Does the system assume that I never sell my primary residence or my beach house, or can it somehow be included that I would sell one or the other at some point in the future?
Yep, great question, Ben. And the answer is totally situation dependent. Unless stated otherwise, the system will never assume that we sell the primary home. And there's a good reason for that. We talk about people, we haven't had someone yet tell us they want to outlive their money. We also haven't had someone yet tell us that they want to be forced out of their home in retirement. And so the way that we like to think about the primary home in the system is kind of that second emergency fund. Say we plan for long-term care for 2 years of in-home care for both spouses, and it ends up being 5 years of nursing care, where it ends up being much more expensive for a longer time. We like to have that home value, the primary home, be that asset that's there for an emergency, to where they could sell it if they needed to fund those needs.
Okay.
Regarding the beach house, right now in this situation, we have it being sold after 20 years, but you can have it be sold after 2 years, or have it also go to the end of plan. You can get as ever specific as you want. Where I see this happen mostly is with vacation homes. Oftentimes people don't hold them the entire time until they're passing. as well
Yeah.
as we have many clients that have investment properties. Maybe they held on to their starter home. Maybe over time they've acquired some rental houses, things like that. But they know that they don't want to hold those for 45 years, 50 years. And so we can factor in expected sale dates for those. And in regards to the value, it'll just inflate real estate at standard inflation rates. So if you're in a market that's been as hot as Charlotte, it's likely understating the value of the growth of that over time, at least what we've seen in recent years. So hopefully building in a little bit more conservative estimate there as well.
That's an interesting point because we also have a number of clients that have rental properties. So when you're factoring in a rental property, are you including the income that goes along with that?
Yeah, absolutely. So just like we looked at the primary home and could list the taxes, insurance, and maintenance, when entering any sort of investment property, whether it's a rental house, Airbnb, what have you, we can enter in those same markers, as well as things like vacancy rates, monthly income, and really, really, again, get dialed in as the client wants within the system.
And I will add to that, we have had some clients come to us and say, okay, well, we're going to knock it out of the park from a spending standpoint for the next 12 years. But after that, we think we're going to pull back on our expenses, and they'll give us that 10 to 12 year budget, and it'll be line itemed, and they want that line item budget right in here in the expenses for early retirement, and we will project that out for them. So if they have a large line item for travel or gardening or racing cars, whatever it may be, we can put all of those in there and they can see it on these separate tiles.
Yep. Yeah, that's a great point, Ben. Just for the sake of the example that we're going through today, I would say this is a relatively high level data entry that we would do in the system. Normally, we would be, in a conversation, be updating this in real time with the client on a large screen, being able to, show and go through all of these different things.
Awesome.
Yeah. But most people are on their lunch breaks right now, so we don't want to spend 2 hours doing that.
Sure. No. Yeah. Nope.
So finally here, that takes us through our inputs. I mentioned having good inputs leads to good outputs. I'm going to click this retirement module to take us to the outputs, finally, after entering inputs for that amount of time. We're going to show these two wheels. That's what pops up first on the screen. But where Ben and I often like to start is this confidence chart. And what this is doing is it's taking the client at their current age and then projecting out all the way to age 95. And it's projecting using not only those inputs that we put in, but their assets, historical returns, and historical volatility of those assets. It then runs 1,000 simulations to give a range of outcomes. So you'll notice the closer we are to the client's current age, that the tighter that range of outcomes is. Whereas when we're looking 50 years into the future, we of course have a very, very large cone of outcomes. When looking at this chart, you'll notice 3 different kind of blue areas. First and foremost is the 5 to 95% confidence level. This represents more or less every simulation that's run in the system. Again, when we talk about the cone of outcomes being very, very wide, this is where the outcomes are at their widest. You're really looking at outliers here. We have the 25 to 75% confidence level, which is often where Ben and I like to focus with clients, because we think that this is a realistic range of outcomes and encompasses not only, call it the belly of those 1,000 simulations, but we think in real life, if we were trending towards a 25th percentile level outcome, say returns aren't as strong as they've been in the past, especially maybe right when you retire and income goes away. We think that most people, if they're in a 25th percentile scenario, are likely to make the cuts necessary, maybe trimming spending a little bit, selling a beach house a year earlier, things like that, in order to move them back up towards the median. And then the opposite is true. On the more fun side, if you're trending towards a 75th percentile level outcome and returns are very, very strong, you now have more money than you knew what to do with at a certain period of time, we often find that people can adjust their spend upwards relatively easy, whether it's discretionary spend, gifting, thinking about bequesting to kids, things like that. So Ben and I often like to focus here as it encompasses the meat of those outcomes. And then as well, obviously the median, this is where people's eyes often go first. That's just simulation 500. So in this case, when looking out using all of those inputs, as well as historical returns and volatilities, in this case for a 70% stock, 30% bond model, or 75%, 25%, sorry about that. Just a pretty standard model for that someone might have at this age. You see the median range of outcomes there at about 12.2 million in financial assets. So again, this does not include the value of the primary home. And then that 25th to 75th percentile showing at about 1.3 million to 25 and change. So again, a very, very wide range of outcomes, even on the 25 to 75th percent range. And when we look at the 5th to 95th percentile, the reason that Ben and I don't often use this besides just showing the range is that we don't think it's super helpful to say you're going to have between 0 and $54 billion. So,
Right.
And again, one thing that we often do is look at this through time, because this person here, as far as we're projecting, still has 50 years left, which is why these range of outcomes are still pretty large, even on the 25 and 75. But as we're working with people in retirement who may be in their 70s and we're just looking out to age 95, that cone does shrink and we can get way more dialed in on what the outcomes could be.
So
So,
let me ask a quick
yeah, please.
question, Nicole. I think we've got some questions in the queue on this. So what if and if you go back to the original inputs from the case study, they said they wanted to retire at 62, but it sounds like that would be the latest that they would like to retire. What happens to the analysis if they were to retire, say, a couple years earlier than that?
Yeah, can absolutely show that. So without knowing the numbers off the top of my head, anything that's going to reduce income is going to lower the analysis, and anything that raises income or savings or lowers expenses is going to raise the analysis. So just by changing it to 60, I know it's going to lower that amount, but let's see by how much. So we've got our new outcome there. Still looks pretty favorable. Now the 25th percentile doesn't go the whole way out. It still comes very, very close, running out at age 89 or 90. And our median that was 12.2 is now at 7.5. And so this is where we can talk with people, and it really depends on the client's risk tolerance and kind of what level of variability they're willing to accept as to if they just look at this and go, all right, sounds great. It's still above 50%. We think we can make the necessary adjustments. We're going to retire at 60. Whereas others say, no, I kind of want that 25th percentile to at least get closer, if not go the whole way out. And that's where we can take a look at other things and say, all right, well, in that case, what would happen if we cut spend just by $500? Again, when we talk about keeping lifestyle the same, if we're thinking about having children and the expenses that are associated with that, and then all of a sudden being retired and they're not on your budget anymore, hopefully, that would still, I would argue, be probably still an increase in lifestyle. Ben, you've got more kids, so maybe you would know better than me, but
Sure.
that number that was 7.5 is now getting closer to 8.8. We can then make changes of saying, all right, what happens if we take Social Security at age 70? Which is not always the optimal strategy, but if you're going to live to age 95 and you know that with certainty is likely, then the taking it later is likely, but obviously consider your own health histories and things like that. Now we're above 8 million. And then you could look
Michael,
at, say, oh, sorry,
Michael,
question.
why would somebody want to wait until age 70 to take Social Security?
Yeah, great question. So the longer you delay taking Social Security up to age 70, you get an additional benefit for doing so. So a greater percentage of that benefit paid to you. The opposite works the same way as well. So full retirement age for most people is 67, 66, 67 and change, just based on when you're born. And if you take it earlier than that full retirement age, they penalize you on your benefit by a percentage. And if you take it later, you get an extra percentage. So it can be favorable if you don't need the income today and you have, say, good family health history, people living late into their 80s or 90s, to delay that Social Security benefit. But the opposite can be true as well. If you need the income early in retirement, say you're 62 and you don't want to start drawing from the portfolio, or if you have maybe health history that isn't working as well in your favor, or if you just want to start getting it and you're comfortable having the lesser benefit, you can take it earlier than full retirement age. And then full retirement age, of course, is just getting the benefit that would be stated to you on your statement when you start to get those.
Got it.
Yeah. Great question, Ben. And so finally, I'll show one more thing in here. Let's say, all right, this physician, their spouse, they're gung-ho on retiring at 60. They're comfortable spending $500 less and delaying Social Security a little bit, but they really want the number to get at least closer to where it was. What if they save an extra 2% each in just the 401ks? It's still not going to be the 12 number, but it's going to be a lot closer. Now we're at almost 8.8 million. I think, obviously don't want to speak for everyone, but most people, when they're looking at this scenario, could say, all right, we still have a very similar lifestyle. Maybe we have to kick it up to gear to save a little bit more, but we can retire 2 years earlier and still likely pass with over $8 million in just financial assets in the bank. So this, again, is where Ben and I have to have conversations with people of just what level of risk are you comfortable with? And then, of course, we can make a decision now, but the big thing are those adjustments through time. How have things changed? Have markets done well? Have you saved more than maybe you thought you would? Is the opposite true? Have markets performed poorly? Maybe you had some bigger expenses this year than you were expecting. And we can actually model those things out through time in order to help keep people on track, hopefully towards that median number.
I think it's really interesting to see the flexibility that people have and how that is modeled out in these scenarios. And we didn't even go into the adjustments regarding allocation, but allocation plays a big factor in outcomes. So getting more conservative in the portfolio or taking on more risk in the portfolio, maybe by increasing the allocation to stock. All of those play a big impact. But this analysis is extremely helpful with us, as Michael said earlier, about how clients will prioritize goals, how they'll prioritize savings, and really understanding what their money can do for them through time. Michael, do you want to go to the cash flows just for a second so people can see how the dollars and cents break down year by year?
Yeah, I'm glad to.
We'll just do it quickly because we'll do it quickly because we are over just by a little bit.
Yeah, I'll keep this very fast, and then I'll go ahead and apologize for how these numbers might look on Zoom. So you might have to squint a little bit. But the cash flow analysis allows us to get really, really granular into, of course, using assumptions based on the inputs, how things might look, not just over time, but on a year-over-year basis. So things like looking at projected income over time, projected taxes. As you get closer to those required minimum distribution ages, when the government says you have to start taking money out of your 401ks and other pre-tax accounts, how do those distributions start to affect your income? And then, it actually will have like a distribution strategy of showing where assets get drawn from the portfolios as well. So we have some people, especially those that like to spend time in spreadsheets, that really like to get granular and spend a lot of time in here. And then others who just like to look at the confidence chart more, and then some that like to do both.
I would say overall, this area is very helpful with a lot of the tax planning that we do. We'll look at the impact of Roth conversions, as well as distribution planning. Very, very helpful, this section of the system.
Yeah, great point, Ben. And Ben, if no other, I'm not looking at the chat box, but if no other questions have come in or you don't have anything else you'd like us to review in the system, I can stop sharing and pass it back to you.
No other questions at this point, and we're about 4 minutes over. You can go ahead and pass it back to me. So again, everyone, thanks for jumping on today. If you want more information from Dolan Capital, you can reach us at info@dolanca.com. Again, info@dolanca.com. You can go to our website at dolanca.com, or you can reach us by phone. All of that information is here. Thanks again for joining. Really, really appreciate you taking time away from your busy schedule and lunch in order to take a look at retirement planning for physicians. We're probably going to do this specific webinar again in the fall. So if you have friends that would want to join, anybody else that you'd want to see this, you can be sure to let them know. This isn't the last time we're going to do retirement income planning, because this is just such a critical component of wealth planning generally. So Michael, thanks for jumping on. Appreciate it. And everybody have a great day.